Look, if you guys are in forbearance, you might want to consider selling, and I'm going to go through exactly why. All I'm saying is if you took advantage of the forbearance because you actually needed it, then you're going to have to figure out repaying that debt in some fashion, whether it's selling the property, a modification to your loan, a repayment plan, and some other options that I described in another video. I'll put a link down in the description for you guys. However, one option that I want to talk about today is the option to actually sell the property. So if you're in forbearance, I believe that there are three types of people that should consider on selling their property. Number one are those who are employed but are uncertain about future employment with the company or industry that they're in. Number two are people who are small business owners that have been negatively impacted by the pandemic. Number three are those who have been living beyond their means, meaning those who have not been financially responsible in their expenditures. And number four, those who are anticipating on potentially selling in the next year, two, maybe even 3 years down the road. Now remember, real estate is micro, so different areas are gonna have different economic factors affecting the real estate market. There are certain areas like New York, certain areas like California that are in dire straits and they're hurting. And then there's other areas in Florida, Texas, and Nevada that are thriving. So you have to take a hard look at what's going on in your real estate economy on a micro level. Now, I believe that we could face a housing crisis due to multiple factors, which I'm gonna cover in another video. Now, I wanna discuss two simple examples and just give some simple math if the market, say, stays the same where it's at right now and it's in a good, healthy real estate market and there's appreciation or kind of flatline, and if the market actually decreases. Let's look at some numbers. All right, now in scenario number one, let's say that the current market value of your property in today's market is $315,000. And let's say you owe $250,000 on it. Again, these are all estimates and you can run your own numbers based on your own local market. You owe $250,000, current market value is $315,000. We got closing costs estimated $22,000. And remember, you got that forbearance. The forbearance you're gonna have to pay off. It's not forgiven loan. So you gotta take this into consideration, which I think a lot of people are not. So in this scenario, you still have equity in the deal and you're gonna come ahead with $22,600 check in your pocket. Now, if interest rates increase, I think that our real estate market is going to get disturbed and I think it's gonna negatively affect housing. There's other contributing factors. Like I said, I'm gonna go into more detail in another video. But not just an increase of interest rates that could disrupt the housing market, but maybe insurance rates increase in your local market. I know in the state of Florida, they're talking about those drastically going up. And again, we'll talk more in detail about that. But let's say the interest rates do go up and let's say insurance rates go up as well, and there's going to be an oversupply of inventory hit the market, which brings down property values. When property values go down, you lose equity. So let's say the current value now is basically what you owe on the property, which is basically a $65,000 spread. So let's look at the numbers. The price now, a year later, 2 years later, because of oversupply of inventory decreases. Now that $315 is now $250. Subtract your debt position out, subtract your closing costs, subtract your forbearance. Remember, you have to pay that forbearance back. And now you're left with paying at closing a $38,000 check. Now let's say you did sell your property in today's market and you have that equity position. You're going to be in really good shape because you were ahead of the curve. But let's say the market does shift. Anything can happen, and as mentioned, if interest rates go up, or if the price of insurances go up, or other determining factors that could bring values down because of an oversupply of inventory to the market, such as some foreclosures, short sales, and other factors. The people that are not ahead of the curve, they could be facing something like this. And I know a lot of people are looking at this video saying, you know, the last housing crash is completely different, which I completely agree. However, there are different factors in our housing market today that could contribute to a housing crisis. And again, this is for information purposes. I'm not telling you to run out and panic and go list your property. But I think that you guys should consider this, especially if you guys do have some hardship, you do have some employment issues, then this might be a viable option for you guys as well. So what's your opinion on the future of the housing market? I'd like to hear below in the comments below. And if you guys got any value out of this, I appreciate a big thumbs up, and I'll see you guys on the next video. See ya.